In our discussion today, we are going to look at IAS number 40, that is to say investment property. I've displayed my contents for a purpose of you being able to contact me should you need my services. I'm a part-time online lecturer in accounting. Anything in accounting, consult PJ. I will be able to help you understand the concepts at an easy, small fee. And we are going to have one-on-one investment property. There are times when a business has to buy investment property. So it is good that we distinguish investment property to property, owner-occupied property, where investment property is got its own standard, and owner-occupied property is also got its own standard, number ACCA-16. So generally today, we are going to look at the investment property, but just a brief background of non-current assets. The non-current assets are grouped into two. There are those assets that are tangible, and those assets that are intangible. Intangible shall mean cannot be touched. Okay, they're not tangible and not tangible. And intangible assets are prescribed in IAS number 38. We should also understand that the tangible assets can either be owner-occupied assets prescribed in IAS 16, or assets held for capital appreciation, or the assets that are purchased solely for rentals that we're going to deal with today. All right, so IAS 40, that's investment property, prescribes the accounting treatment and related disclosures that are required for the investment property. So the scope of IAS number 40 is that it prescribes the recognition, the measurement, and the disclosure of the investment property in the financial statements of the owner or the lessee who owns the property as a right of use of asset. So the big question is, what does not constitute investment property? Number one, biological assets have got their own standards, IAS number 41. Number two, mineral rights and mineral resource are not prescribed in IAS 40. Number three, property used in production or supply of goods or services or for administrative purposes that we looked already in IAS number 16. So another one that does not constitute, or does not constitute in IAS 40, that is those assets that are held for sale, prescribed in IFRS number 5. The times when a company would want to sell the assets. So IFRS 5 has got its own rules on how to account for such. Okay, where we say if the buyer is identified, or there's a prospective buyer for those assets, and we've agreed, the company has agreed the price for the such, and there's a special line in the statement of financial position where you identify those assets separately as assets held for sale, and the sale has to happen within 12 months from the day that were prescribed as assets held for sale. Okay, so what is investment property? Investment property may be land or buildings or part of the buildings held to earn rentals or for capital appreciation, or both. Okay, rather than use in production, as we said already, sell in ordinary course of business, that is prescribed in IAS 2 eventually, and unoccupied property that we've already looked at. So the classification of property as an investment property. So investment property generates cash flows that are largely dependent of the other assets of an entity, okay, as they are held for the purposes of capital appreciation. In contrast, owner-occupied property is held for the production, supply of goods or services, or for administrative purposes, and as such generate cash flows that are attributable to the assets used in production or supply process. So what are we saying when we say that assets that are held for capital appreciation? There are times when a company would buy land. This land would just be dormant, okay, held solely for the land to gain value. We know that land does not depreciate at all, and land appreciates in value. It gains value each and every year. So if a company buys a building, a property, or land that is there to gain the value, that asset is prescribed as investment property. So the most important thing to note is that unoccupied property is accounted for in IAS number 16. So the examples of investment property: number one, land held for long-term capital appreciation. And there may also be land held for currently undetermined future use. The company can just buy land and leave it there. It hasn't yet determined how to use the land and of what purpose the land should be used for. So when an entity is still deciding whether the land will be owner-occupied or sold in the short term, in the ordinary course of the business, until a decision is made that the land is considered to be held for the purposes of capital appreciation, that land is identified as investment property. So a building leased out under an operating lease, a vacant building to be leased out under an operating lease. Remember, these buildings are not earning any income to the business, such that we are identifying these buildings as investment property. So the property that is being constructed or developed for the future use as an investment property. There are also times when a company would construct its own building for the purposes of capital appreciation or renting out the building. So as such, such a building is identified as an investment property. Okay, the following are not investment property. Is not property intended for the sale in the ordinary course of business, as we already earlier, and property held for the use in production or supply of goods or services, and the property used for administrative purposes, and a property held for future use, as we saw already, property held for future development and subsequent use as owner-occupied property, property occupied by the employees. You know, there are times when the company, there are companies that provide houses to the employees. Okay, they're not charging any rent. That's done as a fringe benefit when you're accounting for tax purposes. It's a fringe benefit. It's a benefit in kind given to an employee. There are companies that do that. Okay, so that is not investment property. And owner-occupied property are waiting for disposal. There are times when the owner decides to occupy the property. It was unoccupied for business purposes. Now the owner is not renting out, is occupying the property as his own residence. That is not investment property. Okay, property leased to another entity under a finance lease. So that is the most important thing to note. There are times when the property is partial own use. So how do we account for such? When an entity used part of its property for its own use and part to earn rentals or capital appreciation, the entity should account for each portion separately, okay? But there's a condition: as long as the entity is able to distinguish or classify the independence aspect of the property or each portion of the property, that the property can be sold separately. Okay, that is to say, the portion of the property used for own use should be accounted for under IAS 16. That's owner-occupied property. Property, plant, and equipment, IAS number 16. And the portion that is used to earn rentals should be accounted for under IAS number 40. That is investment property. Okay, if there's a big building that partly the owner is occupying the property for business purposes, okay, the other portion is being rented out or left for capital appreciation. The portion that is unoccupied for business purposes should be accounted for under IAS number 16. The other portion that is there for rentals or capital appreciation should be accounted for using IAS number 40. Okay. There are times when there are auxiliary services. There may be instances where an entity provides auxiliary services to the lessee of its property. When such an auxiliary service are insignificant in nature to the lease arrangement as a whole, the property is treated as an investment property. Okay, where the auxiliary services are significant to the lease agreement as a whole, the property is considered to be owner-occupied rather than investment property. Okay, an example: a company owns and manages a hotel, and the services provided to guests, such as room service, cleaning, there might be a provision of Wi-Fi, okay, such that are significant to the arrangement as a whole. The owner management hotel is owner occupied and it is not investment property because the significant part of it cannot separately identify. That's what I'm trying to say. So account that property as owner occupied property. Okay, although it's there to earn rentals in the form of the fees that people pay, but that is owner-occupied and should be accounted for using IAS number 16. Okay, the examiner might give you such a scenario where the examiner wants you to explain with facts given in the case. So you really need to put your case straight and make sure that you are giving right advice, and you earn marks in the process. So recognition of investment property. So investment property is recognized as an asset when and only when, number one, it is probable that the future economic benefits associated with the investment property will flow to the entity. Same thing that we do in IAS number 16. The probability of the economic benefits. Economic benefits here, I mean the gains. Number one. Number two, it means the rentals that will come, that will flow to the entity. The income. Is it probable that the asset is there to generate the income, or is there to earn a capital appreciation? Number two, the cost of the investment property can be reliably measured. You can be able to measure the value of the property, the market value of the property, or the cost of the property. Okay, so an entity evaluates under this recognition principle all its investment properties costs at the time where they are incurred. The moment you incur costs, if you're self-constructing, the costs that you're incurring to construct the asset, or if you're buying the asset, the cost that you paid to buy the asset, equivalent to the fair value. So these costs include the costs incurred initially to acquire an investment property, and the costs incurred subsequently to add to or replace part of or service a property to make sure that this property is usable, is ready for production, is ready for any rentals, and it's ready for capital appreciation. So an entity does not recognize in the carrying amount of an investment property the cost of the day-to-day servicing of such a property. Rather, these costs are recognized in profit or loss as incurred. Okay, the day-to-day servicing of the property shall mean painting. Okay, if the pipe bursts and you replace another pipe, that cost becomes income-related cost, and it's expensed directly in the P&L. And the investment in property can initially be recognized using cost model or fair value model. Sometimes it's called revaluation model. So the measurement at recognition. Okay. The cost of purchasing investment property includes, but not limited to, the purchase price that you pay for the property, the directly attributable costs. These are costs that are incurred for that can be easily identified as part of the asset, and without the asset being brought to the books, these assets could not have been incurred. That's what we mean when we say directly attributable costs. And number 3, directly attributable costs include the following: professional fees, the times when you pay a professional land surveyor, for example, to quantify the value of the land. Okay, you may pay for a lawyer to draft the agreement for the purchase of the property. Okay, number 2 should be, number 2, property transfer taxes and taxes to acquire a property, those taxes that cannot be claimed from the revenue authority, and that those taxes are accounted for as part of investment property. So the following costs should not be included in the cost of the investment property: startup costs unless they are incurred to bring the property to the condition necessary for its intended use by management, unless, okay, they're incurred to bring the property to its present use. That those costs should not be accounted for as part of investment property. So operating losses incurred before the investment property achieves a planned level of occupancy should not be classified as investment property, and abnormal amounts of wastage, material, labor, and other resources incurred in constructing or developing the property. Okay. Now, accounting for investment property. IAS 40 requires that all entities measure the fair value of investment property for the purposes of either measurement if the entity uses the fair value model, or disclosure if it fits the cost model. So the company can either choose to use cost model and fair value model. It's the same that we do in IAS number 16. So you gotta go back and watch the video that I did for IAS 16 and see how these things are done. Okay. So what I'm saying is that an entity is encouraged but not required to measure the fair value of the investment property on the basis of valuation by an independent valuer who holds a recognized and relevant professional qualification and has recent experience in the location and curriculum of the investment property being valued. The fair value that is used should be done by an independent valuer. Okay, or in absence of an independent valuer, you can use IFRS number 30, that is fair value measurements, where we look at the 3 levels of input. Input number 1, number 2, and number 3. Number 1, where we say current market prices, the prices that are really available. Okay, number 2, market prices for similar assets in the area that the property is located or the asset is located. Number 3, that's where we look at management decisions, judgment. Judgment that is agreed to the principles of accounting. Okay, they may use insured amount, that is market value. Okay, they may use other judgments as it fits. Okay, so an entity may choose either fair value model or cost model for investment property, backing liabilities that pay a return linked directly to the fair value of or returns from specifying assets, including that investment property, and choose either the fair value model or the cost model for all other investment property, regardless of the income made in a above. Okay, so if the company chooses fair value model, how are these investment property accounted for? So what it's saying is that after initial recognition, an entity that chooses the fair value model shall measure all its investment property at fair value. Fair value shall mean the market value. Okay, so should there be a gain or a loss on those investment property, they are charged for in the profit or loss for the period in which the gain or loss is arises. So in measuring the fair value of investment property in accordance with IFRS 13, as I stated earlier, an entity shall measure that the fair value reflects, among other things, rental income from the current leases and other assumptions that market participants would use when pricing investment property under current market conditions. So when a lessee uses a fair value model to measure an investment property that is held as a right of use asset, it shall measure the right of use asset and not the underlying property at fair value. Okay, should there be a lease agreement and fair value, the one that takes precedence is lease agreement, the right of use, not the fair value. That's what we're trying to say. So in determining the carrying amount of an investment property under the fair value model, an entity does not double account assets or liabilities that are recognized as separate assets or liabilities. An example, equipment such as lifts or air conditioning is often an integral part of the building and is generally included in the fair value of the investment property rather than recognizing separately as property, plant, and equipment. The skyscrapers, the buildings that are very tall, they are embedded a lift inside. So that lift is part and parcel of the value of the investment property. Okay. Okay. Let's continue. So if an office is leased on a furnished basis, the fair value of the office generally includes the fair value of the furniture and fittings because the rental income relates to the finished office. So in such a case, we cannot separately identify cost of the furniture and the cost of the building itself. So such that the whole package of right of use is recognized as investment property value. Okay. So subsequent measurement, when we're using evaluation method, what does it mean subsequent? When we say subsequent, generally what it means is that after recognizing the value of the property now, moving forward, how is the company going to account for the property subsequent, after the year end, subsequent, moving forward? Okay. So each year end, a company should check if the value of the investment property is the same or not. How is that done? Using an independent valuer. Okay. If the market value of the investment property at the market increases, then there should be a gain in the value such that adjustments should be made in the carrying amount of the asset. That is to say, a gain in the value of the property will necessitate an increase in the investment property, that is a debit entry, increasing the value of the property, and an increase in the revaluation surplus, credit, in the income statement. Okay. Should there be a revaluation loss where the market value of the investment property goes down compared to the carrying amount of the investment property in the statement of financial position, then the loss should be treated as an expense in the profit or loss. Okay. If previously there was a revaluation gain, then the following year, remember when there's a gain, we are putting the gain in the revaluation surplus. Then in the following year, the company calculates a revaluation loss. We check now the value of the loss comparing to the gain that was previously recognized. Okay. If this loss is more than the gain, before expensing the loss in the income statement, you have to knock off the previous gain in the revaluation surplus. And the balance should be accounted for directly as an expense. That's what I'm trying to say here. If previously there was a revaluation gain, then the following year the company calculates a revaluation loss. The revaluation loss should be expensed to an extent, should be expensed to an extent of the gain made in the previous year. That is to say, before expensing the revaluation loss in the income statement, the portion of the gain made in the previous year should be eliminated with a portion of the loss made this year before expensing it. So if the loss that is made is exactly the gain that was made previously, there won't be an expense in the profit or loss. Okay. An examiner will generally bring this in your exam just to check if you understand the concept. They may give you 3 marks or 2.5 marks or 2 marks, or sometimes 4 marks, especially SBR students, okay, where every point that is made in exam is accounted for as a half a mark. So you need to make sure that you explain in detail or facts what you've been given in the question. Calculation alone doesn't earn you more marks. But if you explain and connect your dots in the case given in exam, that's when you gain more marks. This is why a lot of students fail SBR. Okay. And if you understand SBR, let me give you a secret. If you understand SBR, it's going to be easy for you to pass AAA, Advanced Audit and Assurance, because there is no way, I repeat, there is no way you can pass AAA without having a full background of SBR, of the standards. Because what examiner is examining you is your understanding of audit standards combining with accounting standards at the level of a consultant. This is in my case. So there might be investment property under construction by the owner. And let's see an example. Chelsea Limited acquired a fixed property on 1 January 2013 at a cost of 100,000 rands with the intention to develop the property. Okay, mark the date 1 January 2013 at a cost of 100,000. At 31st December 2013, that is year end, construction of the property was not completed and the construction costs incurred amounted to 450,000. Cost of property 100, cost of construction 450. Okay. If the fair value of the investment property under construction could not be reliably measured at the year end, then the property should be reflected at its cost of 550,000. That is to say, 100,000 plus the 450,000. Okay. If the fair value of the fixed property was 575,000 on 31st December 2013, first year end, Chelsea Limited should have recognized a fair value adjustment or a gain of 25,000. That is to say, 575,000 minus the carrying amount of 550,000. Okay, in profit or loss, in order to reflect the investment property at its fair value of 575,000. That is easy, is it? It must be easy. Now, there are times when the company chooses to use a cost model. So if the cost model is used, the investment property is mentioned as follows after initial recognition. In accordance with IFRS number 5, if it meets the criteria to be classified as an asset held for sale, it should be accounted for in accordance with IFRS 16 if it is held by a lessee as a right of use asset. So we know that if we account for using IFRS 5, if the asset is held for sale, that asset is not depreciated. I repeat, an asset held for sale, we stop the depreciation. We stop the depreciation of that category of asset. Okay. Number 3, in accordance with I-16, that is cost model in all other cases. So I-16 will depreciate the asset if it's earning income to the business. Okay. If the company is self-constructing the investment property, it has to capitalize the cost to date. It should not depreciate the asset until the property is completed and it is earning the rental to the business. Subsequent expenditure incurred in relation to recognized investment property is only capitalized when it meets the requirements for subsequent recognition as contained in IAS number 16 and 40. Okay. Okay. All right. So if subsequent expenditure does not meet this criteria above, these expenses are recognized as repairs and maintenance in the profit or loss section of the statement of profit or loss and other comprehensive income. Okay. So remember the profit or loss, the comprehensive statement of profit or loss account, there's a section of profit or loss up and down at the comprehensive income section. So you should be careful where you are expensing. All right. When we say profit or loss, we mean the upper part. Okay. Subsequent expenditure that is incurred to bring the asset to its working condition after purchase. For example, the renovation of the building, it is also capitalized provided it meets the recognition criteria for the conceptual framework. So if the expense is to improve the earning capacity of the building, that aspect of the cost should be capitalized. Okay. Painting does not earn any capital appreciation. It's just painting. So that is an expense directly in the profit or loss account. De-recognition of an asset. There are times when the asset has to be taken out of the books of accounts. So that the recognition of investment property takes place on, number 1, disposal, when the company wants to sell the asset, or when the property is permanently withdrawn from the use and no further economic benefits are expected at disposal. Okay, let's say the property is destroyed by weather conditions. Okay, and there is no any intended purpose of the asset. What do you do? To recognize the asset, remove it from your books of accounts. That's what I'm trying to say. So the difference between the net disposal proceeds and the carrying amount of the asset is recognized in the profit or loss section of the statement of profit or loss and other comprehensive income as a profit or loss, and losses arising from the sale and leaseback agreement are treated in accordance with IFRS number 16. So when you're disposing of your asset, you check the disposal proceeds, the amount that you get after selling the asset compared to the carrying amount, the value at the net book value. The carrying amount is the value at which you are recognizing your asset in the statement of financial position, and you check the difference. Okay, if there's a gain, that is the proceeds are more than the carrying amount, it's an it's displays an income. If it's a loss, that is the proceeds are less than the carrying amount, then you expense it directly. Make sense? So I should also highlight here that if there were any gains that were in the surplus account, when you're disposing of, when you're derecognizing your asset, you have to reclassify your gains to profit or loss from other comprehensive income, from the surplus account. So you have to knock off your surplus account when the asset has fully been disposed. Here is also a critical area. The examiner will know where to test you. So you need to be clever. Okay, the reclassification of gains from the surplus account. It's a skill that I'm transferring it to you. Okay, the transfer of property. There are times when the property are transferred within the related parties, within the related companies, and how does that fit in the accounting process? So the transfer between investment property and other asset categories shall only be made when there is a change in use. You change the use of the property from investment property to I-16 owner-occupied property. How do you account for it? From investment property to inventory that you need to dispose, how do you account for it? So when there's a change in use, that's when you re-account. So a change in use is evidenced by the following. Number one, the commencement of owner occupation, transfer from investment property to PPE, that now we start accounting for it, and is number 16. The commencement of development with a view to sell the asset, that is transferred from investment property to inventories. The end of owner occupation, transfer from owner occupied to investment property, or the commencement of operating lease to another party from inventories to investment property. So the most important thing to note is that when an entity uses the cost model to account for an investment property, the carrying amount does not change for transfers between the investment property and the owner-occupied property, as well as the inventories. Does not change. No, does not change. You continue with the same accounting process. For transfers from investment property measured at fair value to inventories or owner-occupied property, the fair value on the date of the change is deemed to be the cost of the latter two assets. What you're trying to say is, you are changing for investment property. If you account for as a fair value, the value of the property is that of the fair value. Do not change. Don't change the cost model. Use the same value. That's the emphasis. Okay. So here's a summary of what I was explaining. To say, if you're transferring from investment property to inventories or occupied property, if you're using the cost model, don't change the value. Using the cost model, the inventory owner-occupied, self-constructed to investment property, don't change. The cost is still the same as the one in investment cost model. So if you're using cost fair value model and you're transferring from investment property to inventories owner-occupied, the fair value now takes precedence. The value at which you are recognizing at fair value takes precedence. Fair value model deems the cost of the asset. So if you're moving from unoccupied, assuming you're using fair value, to investment property, asset revalued. So the revaluation gain or loss treated in terms of IAS 16 should be accounted for in the revaluation surplus. That's another critical area. So if you're moving from inventories, assuming you're using fair value, and you're moving from inventories to investment property, the difference recognized in the profit or loss section of the statement of comprehensive income, the difference in the value, since you're moving from inventories to investment property, now you account for using fair value. The difference should be in the comprehensive income section, down there, not in the profit or loss. How it makes sense. So disclosures, in terms of IAS 40, the following information on investment property shall be disclosed. Number one, whether the entity applies the fair value or the cost model. Very important. You need to disclose in your accounts as put a note. Hey, this company is using either cost model or fair value model. And these are the depreciation rates. We depreciate property, this category of property, in 10 years, in 4 years, in 12 years, and so on and so forth. Okay, the criteria developed to distinguish investment property from other assets of other assets classes where classification is difficult. And you should also disclose the extent to which the fair value of the investment property has been measured by an independent valuer with the necessary qualifications and recent experience, and whether no such valuation was done, a statement to that effect. Why didn't the company made any valuation? Okay. The existence and amounts of restriction on realizability of investment property or the remittance of income and proceeds of disposal shall also be disclosed. And it should also disclose the material construction obligations to purchase, construct, or develop investment property, or for repairs or enhancement to the property. Okay, you should also disclose in the profit or loss section of the statement of profit or loss and other comprehensive income the following: the rental income that you generate from the investment property, the direct operating expenses applicable to the investment property that generate rental income, the direct operating expenses applicable to the investment property that did not generate rental income. There may be times when the investment property was just there, not earning any income. You also need to disclose that the income that you report is from property number 1, property number 2. This property did not earn any rentals. Maybe it was too expensive to be rented out. Maybe it was under renovation. Okay. You should also disclose the cumulative change in fair value where an investment property is sold from a portfolio where the cost model is used to a portfolio where the fair value is used. Where the entity adopts a fair value model, a reconciliation of the carrying amount of investment property at the beginning of the period and at the end of the period, showing the following. In the reconciliation, you should show the following: additions resulting from acquisition or from capitalized subsequent expenditure, additions resulting from acquisition through the business combination separately, disposals and assets classified as held for sale, if you are to apply IFRS number 5, net gains or losses from the value adjustments should also be disclosed in your statement of financial position as a note. Okay, the net exchange differences arising on the translation of foreign entities. Should you have an investment property that is not in the country of your origin, it's outside the country, that they use different currency, you need to translate the value of the property to the value at which you're reporting your financial statements, such that if there's a gain or loss in foreign exchange, gains or losses, that one, the translation gains or losses should also be disclosed. Transfers to and from inventories and the owner occupied. Should there be a transfer? Sometimes there's a transfer between related parties. Okay, you transfer plan number A, you sell it internally to the related parties. You must also disclose such if it's significant. So that's the end of our discussion today. And I believe that this enlightened you more or reminded you more on investment property. And I believe that you use this information to the betterment of your understanding in as far as investment properties are concerned. Should you want to check the references, you should check the booklet, IFRS booklet, 2023 edition. And there's a book called Descriptive Accounting. That is 21st edition, written by Kopesha. And I think there are 6 guys who wrote this book. Okay. So just a recap, a quick recap. We said that IAS 40 does not deal with assets that are biological assets, that does not deal with inventories, does not deal with assets that are held there to for production purposes. That is dealt with in IAS number 16. So long and short is that investment property is a property that is there to earn rentals or is there for capital appreciation. So property includes land and buildings and parts or part of the building or both. So undeveloped land may also meet the definition of investment property. So investment property is therefore not property held for use in production or supply of the goods. So in practice, a classification of the property into either owner-occupied or investment property may be problematic, but what most important is that you must know that a property may, for example, be used for dual purposes, namely to earn rentals and for administrative purposes. And I explained how this should be accounted for. All right, good luck.